Before we jump in, I do earn a referral fee when you use the services and companies I demonstrate in the video, but there is no additional cost to you. I chose them because they're the best in the industry and you're safe with them.
Have you ever wondered when to switch from sole proprietor to S Corp? It's a common question for entrepreneurs. Indeed, it's a question that echoes across boardrooms and coffee shops alike. From the seasoned business magnate to the fresh-faced startup founder, the quandary of whether to transition from a sole proprietorship to an S corporation is a shared concern. But before we dive into the heart of this matter, let's set the stage. A sole proprietorship is the simplest business structure, where you, as the entrepreneur, are the business. On the other hand, an S corporation is a bit more complex. It's a business entity that allows income, deductions, losses, and credits to pass through to your personal income tax return. Now, both these structures have their merits and intricacies, but the question remains, when and why should you consider converting from a sole proprietorship to an S corporation? Let's delve into the key factors that could indicate it's time for you to make the switch. Understanding the benefits of an S Corp is crucial to making an informed decision. So let's dive in, shall we? Firstly, let's talk about tax advantages. S Corp can offer significant tax savings over sole proprietorships and traditional corporations. Unlike in a C corporation, where profits are taxed twice, once at the corporate level and again when distributed as dividends, S Corp avoid this double taxation. Profits and losses pass through to the shareholders' personal tax returns, and the corporation itself is not taxed. This can result in considerable savings. Moving on to personal liability protection. One of the main reasons entrepreneurs opt for an S Corp is to limit their personal liability. In a sole proprietorship, the business owner is personally responsible for all debts and obligations of the business. However, in an S Corp, shareholders have limited liability, meaning they are only responsible for the amount they have invested in the company. Their personal assets are generally shielded from business debts and lawsuits. Now let's touch upon the ease of ownership transfer. Transferring ownership in a sole proprietorship or partnership can be a complex and tedious process. But with an S Corp, shares can be freely transferred without triggering adverse tax consequences. The company can continue to exist even if the ownership changes, providing business continuity. Moreover, S Corp can attract investors through the issuance of shares of stock, a feature that can be especially beneficial for businesses seeking to raise capital. And let's not forget about credibility. Operating as an S Corp may help a business appear more legitimate to potential customers, suppliers, and investors, as it shows the company has taken steps to become a formal business structure. While these benefits are attractive, switching is not a decision to be taken lightly. It's important to consider all aspects, including potential drawbacks and the process involved in making the switch. But understanding these advantages can certainly help you determine if an S Corp is the right fit for your business. Like any business structure, S Corp have their drawbacks. Let's dive into the less glamorous side of S corporations. The first hurdle you may encounter is the stricter regulations. Unlike sole proprietorships, where you have free rein, S Corp are governed by a host of rules and requirements. For instance, there are restrictions on the number and type of shareholders an S Corp can have. It's limited to 100 shareholders and they must be U.S. citizens or residents. Also, S Corp can only issue one class of stock, which could limit your capital raising options. Next, we have the aspect of increased paperwork. With an S Corp, you're required to file an annual report and maintain a record of corporate meetings. There's also the need to manage payroll, even if you're the only employee. If you're not a fan of paperwork, this could be a bit of a dampener. Now let's talk about the potential for double taxation. While S Corp typically avoid the double taxation issue that plagues C corporations, there are instances where it can still creep in. If an S Corp was previously a C Corp, it might be subject to what's called built-in gains tax on assets it held while it was a C Corp. Also, if an S Corp has earnings and profits from its C Corp years and makes certain distributions, those can be taxed twice as well. Lastly, changing your business structure to an S Corp isn't an easy exit. If you decide that the S Corp structure isn't working for you, switching back or to another structure can be a complex process. These are not insurmountable challenges, but they do add layers of complexity to running your business. They also underscore the importance of careful planning and consideration before making the leap to an S Corp. The drawbacks do not necessarily overshadow the benefits, but they are important to consider. If you've weighed the pros and cons and decided to switch, You're probably wondering about the process. Let's break it down into digestible steps. First, you'll need to form a corporation in your state. This involves choosing a unique name, appointing a board of directors, and filing articles of incorporation with your Secretary of State. Don't forget to pay the necessary filing fee. Once your corporation is formed, you'll need to apply for an Employer Identification Number, or EIN, from the Internal Revenue Service. This is like a social security number for your business, and it's absolutely crucial for tax purposes. The next step is to elect S Corp status by filing Form 2553 with the IRS. Remember, this form must be filed within 2.5 months of the beginning of the tax year in which the election is to take effect. You'll also need to get the consent of all shareholders to make this election. Now that you've taken care of the legal requirements, it's time to update your business records. This means notifying vendors, clients, and banks about your new business structure. You'll also need to update your business licenses and permits. Lastly, you need to start operating as an S Corp. This means maintaining corporate minutes, issuing stock, holding annual meetings, and making sure you meet all the ongoing requirements of an S Corp. Throughout this process, it's crucial to consult with a business lawyer or accountant. They can help you navigate the complexities of the switch and ensure you're making the best decisions for your business. They can also help you understand the tax implications of switching and how to plan accordingly. Remember, every business is unique, and what works for one may not work for another. So don't rush into this decision. Take your time, do your research, and make sure switching to an S Corp is the right move for you. Switching to an S Corp is a complex process that requires careful consideration and planning. So, tread carefully, plan meticulously, and make sure you have the right professionals by your side to guide you through each step of the process. Let's quickly summarize the key points we've discussed. We began by asking ourselves the critical question: when is it time to switch from a sole proprietor to an S corporation? The answer, as we discovered, is not a one-size-fits-all. It largely depends on your unique business needs and objectives. We then delved into the benefits of an S Corp. We talked about how becoming an S Corp can provide significant tax advantages, like avoiding self-employment tax on a portion of your income. It also offers the potential for increased credibility in the eyes of customers, vendors, and potential investors, not to mention the perk of personal asset protection. However, it's important to remember that switching to an S Corp isn't all roses. There are drawbacks to consider. We discussed how S Corp face more regulations and reporting requirements. They also have restrictions on the number and type of shareholders, which can limit growth and investment opportunities. And let's not forget the potential for increased costs related to legal, tax, and accounting services. Then, we walked through the process of switching from a sole proprietorship to an S Corp. We highlighted the importance of careful planning and timing. We also emphasized the need to file the necessary forms with the IRS in your state and to set up a formal business structure, which includes drafting bylaws and appointing directors. Throughout all of this, one theme remained constant: the need to consult with a professional. Whether it's a business advisor, tax expert, or legal counsel, getting professional advice is crucial. They can provide insight into the complexities of the conversion process and help you navigate the potential tax and legal implications. Remember, the decision to switch from sole proprietor to S Corp is unique to each business owner. Always make sure to thoroughly research and consult with a professional before making this significant decision.